Hello friends, welcome to Adda 24/7. We are in the Shikhar series for BFM. Actually in Shikhar series, as I always tell you, we cover all the subjects. BFM, ABM, ABFM, BRBL. So follow the complete series. Various mentors are taking various topics. I take ABM and BFM. Now importantly remember, in Shikhar series we are covering the objective questions, theory as well as some numericals also. So today I'll be covering the numericals, theory and objective questions. All these three I'll be covering. One case study I'll be covering on tier 1, tier 2 capital. So follow this video till the end. Like this video, subscribe to the video, click on the bell icon. I always tell you this na, and many of you don't do it. Don't, who will go to like button yaar? Just click on that like, simple. Okay, like, subscribe. Isn't it? Do it fast. Okay, let's start. Laziness is something here. There's a saying in Sanskrit, Alasyam Manusyam Mahabaladya Shatruhu. Right? Alasyam Manusyam Mahabaladya Shatruhu. Laziness is the worst enemy of human being. Right? So, do it fast. So, let's start. What are the risks? Three main risks I have covered over here. In fact, there are 2-3 more which I will be covering later. Three main risks in banking are these, which are under Basel 3. Okay, credit risk, market risk and operations risk. Now before going into the details, counterparty, country, all these things, before going into the details, let me first give you the idea of what is this. Okay, idea, what is the idea? Look at this. First, kindly note credit risk. Okay, what is credit risk? See, I have written it over here. Credit risk, the risk that the borrower will not repay the loan or meet other financial obligations. This is basically credit risk. Not repay the loan or meet other financial obligations. What do you mean by this? Not repay the loan. If I have given you the loan and you may not repay it, okay, you will become NPA. That is a risk to me, right? The loan or meet other financial obligations. What do you mean by this? Other financial obligations. Sir, kindly note. Loan money can be given in two forms. One is loan, and second form is also there. Second form is you issue me the bonds, I will pay you money. So the bonds are with me, money is with you. Whenever there is a maturity, I'll give you back the bonds and you'll give back the money. That is the basic logic. But what happens if you give me the bonds, I give you the money, and in the end, you don't give me back my money? Then, so this is meet other financial obligations. This here, kindly note, money can be given in two ways. Okay, one is loan, loan is one, and second is bonds. Second, bonds, issuance of bonds. Okay, some company might issue the bonds, you invest in those in that company, and later you find out that the company has no money. We have na many a times. You have invested in so many schemes up till now. We daily see these schemes, right? The party has issued 1 month money double, 2 month money double, 6 months money double. They give you some paper, you put that money. Afterwards that paper is scrap, raddi, isn't it? So that is basically credit risk. Repay the loan or meet the financial obligations. Okay, it is not. Now this can be in various ways. So credit risk can be in two ways. Let me show you that. Say this. Credit risk can be in either counterparty risk, means your party is bad. The one to whom you have given the loan is bad person. Or there is one more way. One more way is the party is good, but but the bank in which means the country in which that party is there. So that is bad. Okay, means what? What do you mean by this? Means country is good, but counterparty is good, but the country in which this party is there, that is bad. Means for example, let's say Afghanistan. You give a loan to somebody in Afghanistan. Now that person is good, agreed, very good person. But what happens? That Taliban government over there says that no foreign exchange should go out of my country today. Then what? Country risk. Or North Korea. Your party is good, staying in North Korea, but they don't allow the foreign exchange to go out. Some African countries, South Africans, not all. South Africa is a good country. African continent I am talking of. So in that case, what happens? So this is a country risk. Country risk means what? It's also called as a sovereign risk. Sovereign means government risk. Country risk is also called as sovereign. Okay. So country risk means basically your party is good, but the country in which that party is staying is bad. So they don't allow you to repay back the money. So again coming back, credit risk is of two types, counterparty risk and country risk. How to mitigate this risk? How to control this risk? Credit risk can be managed by assessing borrower's credit worthiness, setting credit limits, diversifying the loan portfolio, and something which is not written over here is you can have the hedging. Hedge means derivatives. You can use derivatives, insurance. Okay, derivatives, insurance. You can use any of these to hedge. Hedge means what? Reduce the risk. Hedging means basically reducing the risk. Okay, so you can have derivatives or insurance. Got it? How to reduce it? What do you mean by this? See here, credit risk means whenever you give the loan, you must first check whether this customer to whom you are giving the loan is credit worthy or not. Means whether that person will be able to repay the loan. How will you check this? See this. This you check it using your. See, let me remove it so that shift myself. Yeah. See now. Now okay. Credit worthiness. So borrower's credit worthiness. So important part is credit risk can be managed by borrower's credit worthiness. Means what? You can check this using your let's say ratios, DSCR, current ratio, depending on short term or long term, right? So credit worthiness. Second is what? Setting credit limits. Credit limits means now you can't give a loan more than 10% of your tier 1 capital. That's what RBI says to individual company. That is a credit limit. You can't give, let's say in home loan, you can't give more than so and so amount of home loan. Okay, that is a credit limit. While setting up the loans to various industries, for example, steel industry, you can't give a loan to so and so above so and so limit to steel industry. So this is setting credit limits. Diversifying the portfolio means giving the loans to various sectors. Don't put all the onions in the same basket. I won't say eggs. Onions in the same basket. Don't put all the onions in the same basket or apples in the same basket. Okay. So diversifying the loan portfolio. Hedging already I have discussed. Derivatives. Derivatives means what? What are the types of derivatives? Derivatives can be forwards, futures, swaps, FRAs. Let me write it so that you at least know the names. This year in details we'll discuss it whenever we have this derivatives topics. Forward. Okay, future, FRA. Okay, then forward, future, FRA, then call put options, swaps, financial swaps. These are the main derivatives used nowadays. Okay, then insurance, you know, insurance over here is general insurance, kindly note. Okay, we are not talking of life insurance over here. So that was about credit risk. Second one is what? Ops risk, operations. What is ops risk? Is this. Operation risk can be of various types. One, human risk, IT risk, and process risk. What do you mean by all this? Human, IT, process. Human means Human risk means here the risk due to failures of due to internal failures, employee errors or external events. Employee errors. Human. Employee we have a error. When we work we'll definitely have the errors, isn't it? Only one leg is posted, other leg is not posted. Forgot to keep the register, forgot to make the entry. These things happen. Cash excess, cash this shortage. What is that? Error, right? So due to internal failures, it can happen. What is internal failures? Internal failures means internal failures of this human being also, or our problems also. External events or systems also. External events. External events means what? These are not related directly to you, but for example, flood. If there is a flood in your branch, complete your branch is under water. You saw that now recently, external events, that what? LA fires, Los Angeles fires, right? California fires, you saw this? How many of you saw this California fires? Know about this? Type yes in the comment section. You at least know about this. California fires. Type yes in the comment section. Everyone. Let me check. Type yes in the comment section. California fires. Yeah. Having this. So, external events means that which hamper your services. So this was human being and external events. Second is technology, IT. Sure, it can be due to your internal fraud also. Now fraud can be in various layers of IT nowadays, isn't it? We have so many this layers we keep it, but we have so many malwares. So fraud can be in anything. It can be in IT, it can be in non-IT also. It can be related to human also. Technology failure, server is not there, server not working. This is a common problem you see in your banks. Server not working, right? Cyber security, malwares, so many malwares come in. Malware, cyber security. Operational risk can be managed by improving internal systems. Now, how to control the operational risk? But before that, see this. Technology we did, human we did. Third is process. We didn't deal with process here. What did I give you over here? Process risk. What is this process risk? IT you know, human you know, but what is process? See, if your process is very, first one, either lengthy, then there is a huge chance of error. Number one. If your process is not foolproof, then also there is a huge chance of error. What do you mean by not foolproof or lengthy? Let's see one by one. If in your loan process, you are giving loans and it is taking almost 2 months or 1.5 months to sanction and disburse that loan, home loan, let's say, 1.5 months, no customer will come to you. So then what will happen? You'll have to find out the risky customers. So risky customers means again there is a risk, isn't it? So your process should not be that much lengthy. It should be user friendly. And second is not foolproof. What do you mean by not foolproof? Not foolproof means, suppose my process is not strict about, let's say, I'll give, before disbursing the loan, I'll do the mortgage. That is a basic banking rule. Before disbursing the loan, you should do the mortgage. What does the rule say? Rule says that. But if you don't do it, if your systems are not strong, your process is not strong, your seniors are not strong, seniors don't insist, हाँ चल जाता है, disburse कर ले, जल्दी कर, target करना है, target, वो mortgage बाद में करेंगे, gone. When you say such thing, you are gone. Okay? Your processes should be foolproof. They should never be they should never be overthrown, or they should not never be, means nobody can surpass them. That should be a process. So these were the three types of operations risk. One is human, second is IT, and third is this process. How can it be managed? Improving internal systems, controls, training employees. These are the only ways you can manage it. Internal systems. What do you mean by internal systems? Your IT system should be strong enough. If any entry is beyond the level of some person, it should never go. It should pop up immediately, and it should require a second authorization for any transaction. If such is your case, then it's okay. Otherwise, you will definitely face the problem. Okay? Because if you are able to surpass any of the transaction, kindly note, you will face the problem. Someday or the other, you will definitely have a fraud in your bank. Controls. Your head office, your senior management should be so much in control, so much strict about the processes, that the employees should not dare to surpass it without legal reasons. Okay? And training employees. Training is a compulsion. Every employee needs training. It has to be given the training. Third one is this market risk. This market risk is basically related to short-term liquidity, mainly short-term risk. Market risk also covers a part of liquidity risk, because interest rate risk will affect the liquidity risk. These are the four types of market risk: interest rate risk, equity risk, currency risk, commodity risk. There is one more, liquidity risk. That is also there. Liquidity risk. So that is also you can say a part of this only, because after all, net what happens? Liquidity is always affected by interest rate. If the interest rate goes up or down, your liquidity is immediately affected. Liquidity is also affected by currency. If the currency fluctuates heavily, your liquidity is in the problem. It is affected by commodity. So liquidity means what? The short-term money which you require, urgent money which you require. Now urgent money can be hampered using if dollar tomorrow goes from, right now it's at around 85. Tomorrow if dollar goes to around, let's say, 100, or if it goes to reverse 40, then also your liquidity will be affected. In both the ways it is affected. Too much liquidity is also a problem, because that will cause an inflation. Less liquidity is also a problem, because that will choke your neck, isn't it? You won't be able to breathe if there is no liquidity, right? Currency risk. What is currency risk? Okay, let's see one by one. Interest rate risk. What is the interest rate risk? If the repo rate, mainly whenever we talk of interest rate, we are talking of repo. Here we are talking of actually repo. Mainly repo. So repo goes up or down, it will affect the liquidity. Okay. If repo comes down, there will be huge liquidity in the market. If repo goes up, the liquidity crunch will happen. Equity risk. Equity means what? Equity means whatever I have as a asset. If the share value goes down, okay, of my company, then I'll definitely won't be able to raise the capital again, right? What happened to this Adani Hindenburg? Now Hindenburg is closed, isn't it? Hindenburg is closed, but what did Hindenburg do to Adani? It created a huge problem in equities, right? So equity risk means your share value goes down, the market, you can say, a sort of people get afraid about this stocks. So equity. Currency means you already know dollar fluctuations. As I told you, if dollar goes to 100 from 85, then also problem. If dollar goes to 40 from 85, then also problem. Commodity. Commodity is a major risk in the world, kindly note. We don't understand it, but commodity is a major risk. Everything in your life is dependent on commodity. If tomorrow the steel prices go up, what happens? All your daily life activities go up, means prices go up, because everything changes. Tomorrow if petrol prices or gasoline prices go up, nowadays we have the CNG also gasoline, right? So if they go up, then again you are in a problem. Tomorrow if coal goes up, immediately your electricity hikes. So commodity prices are always, the commodity means anything other than rupees. Everything else is a commodity. So commodity risk, all these are the types of market risk. Okay. Now, say this. Let's understand the definition of this. The risk of loss due to fluctuations in the market prices, such as interest rates, foreign exchange rates, stock prices, right? So fluctuations in market prices, interest rate, all these. Kindly remember, market risk is generally of short term. Short term. Okay. Now already I have explained you the various types, interest rates, foreign exchange, stock prices, right? Now, how to manage the market risk? Market risk can be managed by diversifying the investment portfolio. Diversification. What do you mean by diversification? Just now I explained you. Don't put all the onions in the same market, same basket. Diversifying. Okay. So in this way, what happens when you diversify? All the assets are not affected at the same time. Second part of this is liquidity. If the market creates a, if the market risk arises, interest rate goes up, forex rate goes up, stock prices go up, then liquidity risk will be affected. Liquidity risk means the risk of not having enough cash or other assets, other liquid assets to meet short-term obligations. This is a major problem to many of the banks. Because here, firstly you understand liquidity risk is there in each and every bank. Each and every. Let it be big bank, good bank, bad bank, every bank. Any bank there is a liquidity risk. Now the problem is what do you mean by bankruptcy then? See here, if the liquidity risk can be managed, then it's there, no problem. But if the liquidity risk cannot be managed, then there is a problem. See this, okay? Now read, you can read this. So liquidity risk of not having enough cash or other liquid assets to meet the short-term obligations. So if you are not having enough cash to meet a short-term obligation, what do you mean by this? In your home also you see. In our home also, we know that we have, whenever you get a salary, what do you do first? You first keep the money separate for your EMIs. First thing what you do is EMIs, right? That is a basic requirement. First thing what you keep separate is EMIs. Afterwards, you go for other payments. So liquidity risk means whenever you are not able to pay your compulsory payments, that is liquidity risk. Not able to pay your compulsory payments, right? Then not able to manage the cash means enough cash to pay the short-term obligations like EMIs and everything. Banks also face the same. Suppose if the banks don't get money to pay for the immediate deposit withdrawals, then there's a liquidity risk, right? How can you manage this liquidity risk? You can manage this by improving cash flow management and monitoring market conditions. See here, liquidity risk or market risk can only be managed. It cannot be zeroized. You can never zeroize the market or liquidity risk. Never ever. Operations risk can be controlled, credit risk can be controlled because that is in your hands. Market risk, liquidity risk is not in your hands. Why? Because these are mainly affected by foreign markets, foreign conditions. Means, for example, I'll give you Israel's, not, I won't call actually Israel, the West Asian crisis. Israel fighting with all that Hamas, Iran, or Russia-Ukraine war. Was it in your hands? In any way? Can you go and tell President Putin, stop the war? Can you tell Israel, stop the war? Of course, now he is stopping because now he has given this. Trump has told him, it seems, that stop the war. So what does it mean? That's a separate issue. We need not discuss that Israel war right now. We are here for CAIIB. So the point over here is liquidity risk can be is affected mainly by the foreign events. Okay, liquidity risk can be managed by improving cash flow management and monitoring the market conditions. So you can manage, focus on the market conditions, what is going on, and accordingly work. See here, many of the mutual fund companies, what have they done in last 6 months? Before 6 months only, they knew now the market has peaked. So in this case, what do? They sell all their portfolio, equity portfolio, and shift to either liquid or bond markets. Okay, either liquid or bond markets. Liquid market means related to treasury bills, government bills, where you don't get enough returns but principal is saved. Bond markets means it includes 7 months bonds or up to 1 year bonds, but there is a risk involved in bond market, slight risk, of course lesser than equity. See here, there are three markets basically: equity, bond, and debt, and liquid. Equity is the highest risk, debt is medium risk, and liquid is lowest risk. Okay, got it? So next, reputational risk. This is another type of risk. This is not covered at all in these three above risks. There is one more which is not mentioned over here. That is, I'll write strategic risk. Strategic. Okay. Now, what are these two risks? These are not covered in this 1 to 3 credit market ops. Reputational risk means something. See, first read the definition. Risk of damage of bank's reputation due to poor service, unethical behavior, or failure to meet the regulatory requirements. Means your bank is having some negative news in the newspaper or on the portal. Nowadays, newspaper is not there. Portals. Something bad comes about your bank. This bank is having a fraud of this amount. Immediately, everywhere the news, nowadays it's WhatsApp. It spreads immediately in 1 hour, it spreads in whole of India, Bharat. So risk of damage of bank's reputation due to poor service, unethical behavior, failure to meet the regulatory requirements. Reputational risk can be managed by maintaining high standards of service and compliance. So high service standards you can manage. Okay. So this was about reputational risk. What about strategic risk? Strategic risk means not able to think long term. Kindly note. Long term thinking. Long term. Okay. What is long term thinking? For example, Nokia. Remember, in 2008 to 10, every phone in our country was Nokia. Almost, huh? Every phone was Nokia. Now, where is Nokia? Kodak. You remember this name, Kodak? How many of you remember? It's a film company. Film. It was this among the top 10 companies in the world. Top 10 in the world, not in India. It was in top 10 in the world. Now where? Gone, right? So basically, why did these companies go down? Because of strategic thinking. They didn't see what the future was. Okay, so that's why it's gone. Camera companies, many of the camera companies are facing the problem. Why? Because mobiles, look at the mobiles now, the sharpness, the whatever you call it, resolution are so strong in mobiles that you don't, many of you don't require this what cameras at all, isn't it? So camera companies are almost facing the problem. Of course, they have changed, they have tied up with these mobile companies. Okay, but that is a problem, right? Now let's solve some questions. Which of the following activities are included in treasury management? So which is included in treasury management? Fund management, risk management, forex operations, profit maximization in money market. A is 1 2 3, 2 3 4, 1 3 4, 1 2 3 4. So which is included in treasury? Because here risk management in banking is mainly related to treasury. Fund management, yes, it is there, right? You have every treasury has to look at it that the liquidity crisis is not does not arise. Liquidity crisis should not be there. Every company, every firm, every bank has to look at it. There should not be a liquidity crisis. What do you mean by this? Here, if you have too many long positions, means you have bought many stocks or bought many commodities, bought many bonds. But what happens? You don't have, let's say, uh, that much money. Okay, money is locked. So in that case, what do we do? So fund management, that will be a crisis. You will face a liquidity crisis. Risk management. If you can't see that Russia-Ukraine war is going on and you take the long positions, you'll face a problem. Forex operations. Okay, forex operations means dollar rates are up or down. You don't see that. Then what? Again you are in a problem. Profit maximization. Your main target in banking is should always be profit. So all these four parts, right? What is the answer? D. All these four, right? A, B, C, D. All the four. Okay. Internationally, a committee approach to risk management is being adopted. Which committee deals with different types of market risk? Which committee deals with market risk? Now kindly remember these committees are of three types. Okay. CRMC, CRMC, ORMC, ORMC, and third one I won't write it. First, CRMC is Credit Risk Management Committee, or it's also called as Credit Policy Committee. Okay, Credit Risk Management Committee. Okay, or it's also called as Credit Policy Committee. Depending on bank to bank, they'll give you any name, but logic is same. ORMC is Ops Risk, Operations Risk Management Committee. Okay. So ORMC. But what is the third one? Credit got, operations got. Where is this third one? Market risk. Is it MRMC? Market Risk Management Committee. MRMC. But there's no name of MRMC. ALCO is there. Asset liability management, credit policy, liquidity policy, credit liability. There's nothing called as MRMC. So this name is known as ALCO. Asset Liability Management Committee. Correct. A is the answer. Asset Liability Management Committee. It always manages the market risk. It is always, kindly note, ALCO always manages the risk for short term. Okay, short term. Okay. Because ALCO deals in market risk. Market risk is always dealt in for short term. Firstly, somebody might argue, sir, we must think for long term also. Long term it's there, agreed. But that's called as non-deliverable forward. That's a separate aspect altogether. Always remember, short term, banks should always look at, RBI also focuses on 28 days liquidity. RBI has a major focus on 28 days liquidity. Okay. So mainly ALCO focuses on short term. I told you I'll be solving one case study. This is a case study. XYZ bank has risk-weighted assets. If the credit and operations risk are 5,000 crores, market risk is 2,000 crores, paid up capital is 100 crores, free reserves are 200 crores, PNCPs are perpetual non-cumulative preference shares 300 crores, provisions for contingencies 100 crores, revaluation reserves 200 crores, subordinate debt 100 crores. Calculate the total capital of XYZ. So you want total capital now. Total capital means what? Tier 1 and Tier 2. T1 and T2. Kindly note what is Tier 1 and what is Tier 2. Tier 1 is known as free capital. Free. You don't have to pay any interest on this. This is paid capital. You have to pay interest on this. It is also called as going concern. Going. This is called as gone concern. Gone. Means you have compulsorily you have to give the interest. Here you don't have to give the interest. In T1 you have what? Mainly I'll give you shares, not preference shares, common shares. Then net profit, reserves, and revaluation reserves, reval reserves. This is a part of your CET1, CET1, okay. And then you have next is 81, that is PNCP. Let me bring my good face above. Then PNCP and IPDI, innovative perpetual debt instruments, okay. And T2, paid capital is gone concern, means compulsory payments, whichever are there, all these, other than these all, everything is, that's this T2 capital. So let's solve one by one. T1, what did I give you? Shares. What is given? First only look at the capital, okay. So credit and ops risk is 5000 crores, market risk is 2000 crores. Has risk weighted assets. Paid up capital is rupees 1000 crores. See, first focus on paid up capital. Paid up capital 100. So let's look at it. Paid up capital 100 crores. So 100 is there. Let me write it. Shall I write it over here? Yeah. First solve for T1. T1. Paid up is 100 crores. 100 paid up. Paid up. Then what is the next one? Paid up. After paid up, you have what is this next? Revaluation reserve, right? Revaluation reserve, you have 200 crores. 200. So 200 crores revaluation. Here there are reval reserves. Let me see. One sec. What is this? Reval reserves is 200 crores. Subordinate debt, that's okay, separate. Preferences, provisions for contingencies, that's okay. 200, which is the free reserves. What is this? Free reserves 200 crores. See this, this free reserves is 200. This I'll take it as free reserves. Free, not reval. Because the reval is different. Free reserves. Okay. Now I'll come to reval reserves. Reval reserves are to be taken at 45%. In 55% discount. So reval reserves are how much given? They are given as 200 crores. So 200 into 45%. Always take this 45%. Okay. So 200 crores into 45%. Solve this. What is the answer? Oh, let me bring myself down now, isn't it? So 90, I think so, isn't it? 200. That's so simple here, isn't it? Even I got confused. 90. Okay. So 90 crores. Reval is 90 crores. Done. Then what? Next. What is the next one? Is there anything remaining? Let me see in T1. 100 done. This 200 done. What is this? Cumulative. Yeah, PNCP is there. 300 crores. We did this? No. PNCP. That's also part of T1 only. 300 crores. 300. So take this also. So what is the answer now? 200, 300, 600, 690. 690 is your T1. Now what about T2? T2 is the other one. Let's see T2. T2. In T2, what do we do? It's a paid capital. So in paid capital, what do you do? That revaluation reserve is gone. There is something called as, what is this? RWA is given. Total RWA is given 5000 and 1000. So what is my total RWA? RWA total. So that is equal to 5000 and 2000, isn't it? Yeah. So 7000. 7000 is my total RWA. So this what you have to do is 1.2 that is for contingencies. This reserves which provisions what we keep is either the given figure. Okay, either it's a given figure or, kindly note, either it's a given figure or I'll write it over here so you'll understand. Provisions for contingencies. Provisions for contingencies. So either it's given figure, means that is what is given 100 crores, or 1.25% of your RWA of 7000, whichever is lower. So now calculate this. 1.25% of 7000. Do 1.25% means divided by 100 into 7,000, 7,123. So it is 87.5. So 87.5. So lower of these, either 87.5 or 100, whichever is lower. So take this. So contingencies 87.5 for provision for contingencies. Provision contingencies. Okay. Provisions for contingencies. Okay, 87.5. Next is what? That is done. Then sir, some books give this revaluation reserves in T2, but it's actually T1 now. Okay. Next is what? 200 crores free reserves is there. Then what is the next one? What was that? This now. Say this. What is the next one? Next one. 40. That is gone. 200 crores. What is this? Have we taken this? Free reserves we have taken. Then paid up capital we have taken. Free reserves, PNCP taken. Provision taken. Revaluation reserve taken. Subordinate debt is there. Subordinate debt is 100 crores. So mark this subordinate debt. Isn't it? This subordinate is there na 100. So subordinate debt. Subordinate 100 crores. 100, that is subordinate. That is to be taken as full. Subordinate. Okay. So that is also done. Subordinate is also done. Is there anything remaining? Let me see. PNCP done. This revaluation reserve done. 200 crores was for what? 200 crores was for, was there anything? 5,000, this 200 crores. Free reserves, that is in tier 1. Paid up capital 100 crores, that is in tier 1. PNCP 300 crores, tier 1. Provisions for contingencies 100 done. Revaluation reserves, tier 1, gone. Subordinate debt 100 done. That's it. So your tier 2 will be 187.5. Some books give it some different figures, okay, but that's wrong. Okay, tier 2 is always lesser over here. Got it? Because this in this revaluation reserve is gone. Then revaluation is gone, and then what was this? 200 crores something was there. Is there anything called as 200 crores? Can you see something other than this free reserves? Free reserves is 200, paid up capital, non this, nothing. Yeah, revaluation reserve is there. But these two are a part of tier 1. Let me see, I have marked it now. 200 over here, free reserves I have marked. Revaluation reserves I have marked. Yeah, subordinate debts, no, that's it, nothing else. That's it. So 187.5. So what is your total capital then? Total capital is what? 187.5 plus your 690. So do it everyone. So total is 690 plus 187.5. Do the calculations. Okay? Everyone do it fast. Okay? Now, before going, let me show you something. Okay? We at Adda 24/7 have brought in something great. What is this great? You have the Mahapack. Many of you know the Mahapack, right? We have brought in more than Mahapack. What is this Mahapack? Let me show you. Okay? What is this Mahapack? This is a new Mahapack. It's a JIB. This is for JIB basically. All your friends. Tell your friends who are in JIB. Okay? For CIB we'll be bringing it later. But tell your friends who are in JIB that Adda 24/7 has brought in JIB Mahapack. Okay? Let me show you. Very good one. Those of your friends who are in JIB, kindly tell them without fail that purchase this JIB Mahapack. Okay? Oh, it's over here. Hold on. kindly tell your friends about the JIB Mahapack, because this is the best thing to happen to JIB students. You get not only your books, Mahapack, but also your books. So tell all your friends. Now for you as a CIB student, what should you do? See, for CIB we are having our own Mahapacks and huge discounts are going on. So go to this. How to go about it? Always go through the app. In the app you will be getting 1% extra. Okay? Always go through the app. 1% extra through the app, through the coin system. So go to Adda 24/7. Okay? Go to Adda 24/7. Click on JIB and CIB. Look at this. Let me show you. Yeah. So this. Go to Adda 24/7. Click on JIB and CIB. Click on CIB. See this new batch, bonus batch, starting from 24th of Jan. Don't miss it. Ebooks, mocks, online tests, everything you are getting. Best in class material, latest pattern, self-paced learning. And what is the discount? Click on buy now. Put the code Y432. Y432. Click on apply. 79% discount you are getting plus 1% extra, 80%. Net 80% discount. Buy it immediately, but never forget the code Y432. Also, you can buy the Mahapack. In Mahapack right now, you're getting double validity. You buy for 6 months, you get it for 12 months. Again, discount is there 79 plus 1, 80%. But for that, never forget the code. Okay? And do buy the batches immediately. Join the batch immediately.